Everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at WisdomTree Asset Management. I am honored and proud and pleased to have on two of my colleagues from WisdomTree, Jeff Weniger, head of equity strategy, and Sam Rines, macro strategist for model portfolios. Gentlemen, thanks for joining us.
Thanks, Kevin. It's always a blast.
So what we wanted to do is make this a hard-hitting kind of part of our recurring series, talking about what's going on with global trade, specifically global trade's new fault lines, and how should we be positioning for the headlines that we will no doubt be seeing weeks and months ahead. And Sam, I wanted to turn to you first because, we're starting to hear glimpses again in the press that maybe India and Japan could be that first sort of low-hanging fruit for the Trump administration to come up with a deal. What do you think? What's the latest on that?
We've been negotiating, the U.S. has been negotiating a free trade agreement with India since before Liberation Day. That's no surprise that India is at the top of the list, likely to be one of the first. And frankly, Japan already has an outline of a free trade agreement with the U.S. because they negotiated a free trade agreement with the U.S. years ago called TPP. The U.S. decided not to pursue that. And it's a pretty straightforward agreement, right? It's a free trade and you go from there, right? There's always a few little carve outs, a few little niches that, both sides kind of want to say, we're not really interested in having that. But frankly, South Korea is probably pretty close too. We already had a free trade agreement with South Korea. There's only a few tweaks that we really need to do around the edges there. So between the Republic of Korea, Japan, and India, you're likely to continue to hear positive headlines and eventually an outline of a free trade agreement to be signed at a later date. Again, I don't think we're going to hear this is a free trade agreement ready to be signed. What you're likely to hear is we have a framework that both sides have agreed on. We're going to iron it out, but it's going to take time. Free trade agreements are thousands of pages long. Like we are talking, these are catalogs, not books. They're very boring to read. They are highly technical. It is something that is going to take time, but I do think that we're going to continue to have positive headlines around our Asian allies, very close allies, and you're going to hear at least frameworks, if not more than a framework over the coming weeks.
So arguably the ultimate target here is China, right? So in your geopolitically risk-aware models, Sam, what are you thinking on that front as we move forward?
I really do think that it is likely to be an India-centric, call it emerging world from here on out. You have a much faster growing economy than China, much younger economy in terms of population, and capitalist and democratic. Those tend to be things that you want to look at. So when I think of what does this really do in the long run, it's 100% targeted at China. The administration hasn't really hidden that. And when you look at who is likely to be the beneficiary of these actions, there's really only two countries that benefit a lot from it if they can negotiate with the Trump administration and get a trade deal done. And that is India and that is Mexico. And there really aren't a lot of winners outside of that. A lot of countries tend to have Chinese, call it, it's like a third party type of deal where a Chinese company goes to a place that has a free trade agreement with the U.S., manufactures a lot of stuff, and then gets around tariffs by exporting it to the U.S. from those third countries. That's Vietnam, et cetera. You're going to see a lot of struggle for those heavy third party countries to negotiate with the U.S. It's going to be very, very difficult. And frankly, the U.S. is kind of targeting exactly that. So in my mind, it's very simple to go to India and manufacture iPhones, not just for the U.S., but also for India. India is a massive potential market for a lot of U.S. businesses. And it makes sense. for them. So to me, it's really India's the big winner here. China's 100% the target, and Mexico's likely to win on the margins.
So, Jeff, let's bring it here back to the States. I
Sure.
mean, what we saw in April with the VIX, spiking, probably one of the largest that we can remember, at least in recent memory. But in your opinion,
hmm
sometimes this kind of volatility could represent buying opportunities, yes?
Yeah, absolutely. And it was. And you get a big, furious relief rally here. We don't know how much more staying power there will be to it because there's already been a lot of the easy money made. But certainly, I mean, it was a little bit. I think it's fair to use the P word here, preposterous, to describe a risk-off reaction akin to the September 11th and the Lehman Brothers reactions. I mean, the VIX hit 60 3 or 4 weeks ago. I just couldn't assess this trade war and see anything among an order of severity like that. Or similarly, COVID, I mean, 30, 40 million people were temporarily laid off. And the stock market tanked from February to March of 2020. That seemed like a much bigger deal than this. I mean, just because I just started adding up the dollars and cents of these tariffs and I see it as an economic hit. But Kevin, as we talked about, it's not that big of a hit. I mean, one of the things that we were kind of winking at each other with regard to the minds and the markets piece that you and I write is look, the IMF had a 2025 global GDP estimate a few months ago before all this was really hitting the fan. It was 3.3. Global GDP growth in 2025 will be 3.3. Okay. Now we've got this big, massive, scary trade war. And look, I don't want to undermine it. Okay, it's serious. Okay, it's an embargo on China, but they downgraded from plus 3.3 to plus 2.8. And for that, I was supposed to send the S&P from 6,100 down to 4,900 for that type of downward revision. I think this was a tempest in a teapot. I think you got to remain bullish if you want to be bearish equities. Point to something like valuations, not the trade war. As Sam was pointing out, just think about what Sam was saying. South Korea, India, Japan. Now, if I was to ask anybody here on the line, what three nations would you say have historic hostilities with China? Those are the three. Those are the three that are going to come to the table first with negotiations with the U.S. This is pretty clear. It's China only. I suspect trade deals will be coming with most of these nations in the next 12 to 18 months. The problem, as Sam was pointing out, is these are thousands of pages. I think people are thinking 12 to 18 weeks. And that might be something we have to worry about. You can't just get this stuff signed over coffee on Monday morning.
So, I mean, obviously one of the big focal points here is what is the Fed going to do? And obviously, we saw a week or so ago the headlines again, some of the pressuring coming from the Trump administration. And we just want to go on record in saying that Fed Chairman Powell can't get fired because he's not cutting rates to the president's liking. Okay. So we need to put some of that silliness behind us and focus on what is the Fed going to do, not what they should do, but what will they more than likely do? And they're data dependent. We continue to hear that. Next week, we have another FOMC meeting. And I think we're going to hear that underscored as well from Powell and the voting members from the Federal Open Market Committee. And so we'll wait and see. Now, we'll have a couple of jobs reports between when we're recording this now to when we actually see for the June meeting. So, if you were to get two very weak reports, does that raise the specter for a rate cut in June? Yeah, it probably does. But that's the line, right? That's the threshold that we're talking about here for the Fed, that they don't want to necessarily be preemptive. They're going to wait and let the data come to themselves. So, when you hear Fed funds futures are looking for 4 or 5 rate cuts, take it with a grain of salt. Listen to the Fed chairman himself. I think the Fed's going to continue to provide that kind of guidance. But what that doesn't do necessarily is remove volatility we talked about in the stock market, but in the bond market as well. Now, the MOVE index, which is the bond market's VIX, is once again in elevated fashion. So I wanted to turn to the last part here. How do you play this market, stocks, bonds, as we go forward? We mentioned a few minutes ago from Sam's geopolitically risk models, how to focus there. In terms of fixed income, Treasury floating rate notes. Those have been the area that we continue to suggest investors considering at this stage. And USFR, which is our WisdomTree floating rate treasury fund, if you look at the shape of the yield curve, floating rate note yields are actually higher than the 10-year treasury yield. So it is still inverted when you're looking at those instruments, but you're only looking at 1 week of duration. So it's income without the volatility. So Jeff, I wanted to kind of give it to you for the last word here. On the equity side, when people are looking, how do I play this? There's so many headlines and things on social media. Break it down for us. Give us kind of like the simplified version. What should we be focusing on?
The short elevator pitch. I mean, look, you can't get in anybody's head, but people are looking for downside risk. They got to stay long U.S. equities, but I don't know about this market. I think the trade war is more severe than others would expect. That type of sentiment. We've been pointing people towards DGRW being a large blend mandate that has had a pretty nice history of falling by smaller orders of magnitude than the market during bearish situations. Value kicking growth's butt this year. Sometimes stick with what's working in the market. So some of the value mandates, DLN, DHS doing well. A lot of inbounds on, I need to stay long emerging markets. I'm totally freaked. I don't want any China. You got a couple of them here in the house that don't have any China in them. That would be XC, as in ex-China. And then DGRE, which is the quality dividend growth over there in emerging, doesn't have China either. And then if you want to get long, say pure play, close ties with Trump, get a deal done, don't want to have to deal with anything, then I think some of the stuff Sam was pointing out, the India strategy, just getting long India as a future of EM, that would be EPI.
Thanks, guys. Sam, Jeff, really appreciate you coming on. We're going to continue to provide this kind of insight and solutions for you over the next weeks, over the next months. Let's just call it pretty much throughout the rest of this year. So if you like what you're hearing, please tell your friends, tell your neighbors, tell your colleagues to come on and listen to Basis Points podcast. That's it from here. Have a great rest of the week, everybody.